Hey everyone! Welcome back to the channel. If you're new here, don't forget to hit that subscribe button and ring the bell to stay updated on all the latest news and updates in the world of UK pensions and personal finance. Today, we've got a big one for you, especially if you're someone who depends on the state pension. The Department for Work and Pensions, DWP, has just announced some significant changes to the state pension in 2025. These updates include new payment rates and eligibility criteria that could affect millions of people across the UK, including those of you who are already receiving your pension, those of you nearing retirement, and even those of you still far off from retirement. Whether these changes are a good thing or not is up for debate, but one thing's for sure, you need to be aware of them. So, let's dive right into all the details and make sure you understand what's coming next for the state pension in 2025. 2025 State Pension Update, Key Highlights. Alright, let's get straight to it. In terms of the big updates, there are essentially two things everyone is paying attention to right now: the new payment rates for the state pension and the eligibility criteria changes that could impact when you can start claiming and how much you can get. So, first, let's tackle those payment rate increases, because, let's face it, that's what you probably want to know most about. The DWP's recent announcement for 2025 revealed that the basic state pension, for those who reached pension age before April 6, 2016, is going up to £156.20 a week. That's a rise of £5.10 a week compared to last year. While it might not seem like a huge jump, we all know that every bit counts when it comes to making ends meet. And for the new state pension, which applies to people who reached state pension age on or after April 6, 2016, the amount is going up to £203.85 per week. This marks an increase of £6.50 a week. Now, these increases aren't massive, but considering the current economic climate with rising costs, they are certainly a welcome change. However, this isn't just about numbers on paper. These increases are also tied to the triple lock guarantee, a policy the UK government has used to ensure that the state pension rises every year by the highest of inflation, average earnings growth, or 2.5%. For 2025, inflation was the main driver, so that's why you're seeing these increases. Triple lock guarantee and how it affects your pension. Now, you might be wondering, how does this triple lock guarantee really work? And what does it mean for your pension going forward? Well, as I just mentioned, it ensures that your state pension rises every year by the highest of three factors: inflation, average earnings growth, or a minimum of 2.5%. In 2025, the increase was tied to inflation, which has been 6.3% this year. So, that's why pensioners are seeing this increase, but it's important to understand why inflation plays such a significant role in this process. Inflation, which refers to the increase in the cost of goods and services over time, impacts everyone, especially pensioners, who may already be living on a fixed income. When inflation rises, the purchasing power of your money decreases, meaning your money doesn't go as far as it used to. The triple lock guarantee was designed to address this issue by ensuring that state pensions keep pace with rising prices. So, while this year's increase may feel modest, it is, at least, in line with the current financial pressures many pensioners are facing. But here's the thing, this doesn't necessarily guarantee huge increases year after year. If inflation were to drop or earnings growth slows, pension increases could be more modest. So, the triple lock is something that will continue to evolve based on economic factors. Eligibility criteria changes: who's affected? Moving on to eligibility, this is where things get a bit more complicated. The eligibility criteria for the state pension are changing in 2025, and these changes could affect both new claimants and people who are already approaching retirement. Let's first talk about the state pension age, which has been gradually rising, and how that might affect your future plans. Raising the state pension age. As of 2025, both men and women will have to wait until they are 67 years old before they can claim the state pension. This is part of the government's long-term plan to gradually raise the pension age, reflecting the fact that people are living longer and staying healthier for longer. If you're born after April 5, 1960, this means you'll be looking at claiming your pension at 67 instead of 65, which is a significant change from what many people have expected for decades. For those of you who have already planned for a retirement at 65, this change might feel like a bit of a setback, and for those of you in your 40s or 50s, you might need to adjust your retirement savings plans accordingly. If you've been anticipating the state pension to kick in at 65, this shift could force you to wait a couple more years before you receive that critical income. Of course, this decision isn't just about the government being mean. The government argues that because of rising life expectancy, this policy is necessary to ensure that the pension system remains financially sustainable in the long run. And while it makes sense from a macroeconomic perspective, it's still frustrating for individuals who feel like they've been working hard their entire lives and now have to work even longer. Changes to national insurance contribution requirements. Next, we need to look at the national insurance contributions that determine how much you'll receive from the state pension. For anyone hoping to claim the full new state pension, you'll still need 35 qualifying years of national insurance contributions. However, if there are gaps in your national insurance record, you may not be eligible for the full amount. This is where things can get tricky for some people. The DWP has given individuals the opportunity to fill in those gaps by making voluntary contributions. This is especially important for people who may have taken time off work due to things like raising children, being a full-time caregiver, or experiencing unemployment. If you have missed years of national insurance contributions, you can buy back those years to ensure that you're eligible for the full pension amount. However, not all years are eligible, so you'll need to check your record to see which gaps you can fill. This is where I'd advise anyone watching to check their national insurance record as soon as possible. If you're nearing retirement age and you have gaps, it's better to know early so that you can make the necessary contributions to boost your future payments. Thankfully, the government has made this process a bit easier with their online service that allows you to check your NI record and fill in the gaps if needed. Impact on women and gender disparities. One of the biggest concerns with these changes is how they affect women. Women are more likely to have gaps in their national insurance contributions due to things like taking time off to raise children or caring for family members. As a result, they are often at a disadvantage when it comes to receiving the full amount of state pension. The DWP has acknowledged this issue, and there have been some attempts to address this disparity. For example, they've launched a new online tool that helps people identify any gaps in their NI record and even gives guidance on how to fill those gaps. This tool is particularly beneficial for women who may have taken time off to care for children or relatives. The government is also considering measures to make it easier for women to catch up on missing contributions, but there's still more work to be done in this area. The unfortunate reality is that women are more likely to rely on the state pension as their primary source of income in retirement, particularly those who have worked part-time or in lower-paid jobs. So, while there's been progress, it's clear that there's still a long road ahead in terms of addressing these gender disparities. Are there any other big changes? Besides the updates to payment rates and eligibility, there are a few other changes in 2025 that are worth mentioning. One of the biggest focuses is pension transparency. The DWP is requiring pension providers to provide clearer information about your state pension forecast. This means that, if you're unsure about how much you'll be receiving when you retire, there's now an easier way to track that information. Additionally, there are discussions about future reforms to pension credit. For those of you on the lowest income brackets, pension credit could play a vital role in boosting your pension income. There may be upcoming changes that could make it easier to qualify or increase the payments, so keep an eye on that as well. What you should do now, practical tips. So, what should you do with all this information? First, if you haven't done so already, check your national insurance record and make sure everything is up to date. If you have any gaps, see if you're eligible to make voluntary contributions to fill them in. Second, if you're nearing retirement, start planning for a later retirement age of 67, especially if you were planning to retire at 65. Adjust your retirement savings accordingly to ensure you're not caught off guard. Finally, keep an eye on the government's announcements. particularly about pension credit and any changes that might affect those on lower incomes. The more you know, the better prepared you'll be for your future. Well, that's everything you need to know about the 2025 state pension updates. I hope this video helped clear up any confusion and gave you a better understanding of the changes coming your way. If you found it helpful, don't forget to give this video a thumbs up, share it with anyone you think might benefit, and leave a comment down below. Are you happy with these updates, or do you think the government needs to do more? I want to hear from you. Thanks for watching, and don't forget to subscribe for more videos just like this one. Stay tuned, stay informed, and I'll see you in the next one.